Hey guys, I'm Paul Lynn. I want to talk to you today a little bit about some investing and trading. In particular, the subject of risk management or risk mitigation, bringing our risks down as low as possible. If you're new to trading, you've undoubtedly heard people saying, "Oh, be careful. You can lose all your money in stocks and, trading and, and all these different things." You've probably heard people talk about trading on margins and short selling and options and futures and things like that. And absolutely, there are some instruments out there that are inherently risky. True story. There are others which are significantly safer. And I just want to give you an idea, a very broad overview of some of the ways that traders and investors can minimize their risks. There's always going to be risks. I mean, no risk, no reward, right? It's just that simple. There's no such thing as zero risk trading, which is 100% profitable, and you're just going to walk away making oodles and oodles of money and never risk losing a penny. If anyone tells you that, they're lying to you. Run from that person and do not ever take their advice. Okay? Trading is buying and selling. It's buying something today with the hope of selling it at a later time for more money than you paid when you bought it. That is the essence of trading. When you get into other things like derivatives and options, okay, granted, it works differently. But I'm just talking to you about basic trading on a cash basis. You use the money which is in your account. If you don't have the money, you can't spend it. You buy stock, and then you sell stock which you have in your account. Okay, you can't buy without the money without your own money, and you can't trade stock that you don't own. That's called cash basis trading. That's all I'm really talking about right now today. Okay, so what are the risks of trading or investing? Well, when you think about it, trading and investing, let's pretend you're talking about stock, which is certificates of ownership of companies, right? So when I buy, 10 shares of Microsoft, that means I own 10 shares out of however many millions of shares there are of this company. I am now a partial owner of Microsoft. Woohoo! Bill Gates, eat your heart out, baby. I don't think he's worried about me too much if I only own 10 shares, because he owns about probably 10 billion shares. But hey, the idea is, what happens if that company is successful and keeps growing and they just dominate the software market and they start making phones again, but people actually like them this time, and they start making more computers and they actually catch on for a change and people start buying them, and then they release the next version of Windows, and unlike the last 50, this one actually doesn't suck, and it's actually a joy to use, and it performs well. Well, people start throwing money at this company, and everyone wants a piece, and people start trying to buy the stock, and the law of supply and demand drives the price up. And you bought 10 shares, for maybe a couple $100 a piece, and now one day, you're selling them for a couple $1,000 a piece, and you say, hey, that was a good investment. But what happens if Microsoft just sucks worse and worse every year, and Windows just sucks even more than it always did, and they invest a ton of money in things that just don't impress the market, and they have to take a lot of write-offs and losses, and things just keep getting worse and worse? Well, your investment is going to depreciate over time. Nobody wants to invest in a company that seems to be in the toilet and can't do anything right. So if you bought Microsoft one day when it was mediocre, and then 5 years later the company is perceived as being an outdated dinosaur that's lost touch with its market and can't bring a good product to sell, now everyone's throwing their stock away. They're using it as toilet paper. And, the money you put in you bought some stock that has lost its value. That's where the risk comes when you're talking about investing. You buy into a company today, and that company is great, and it sounds good, and it's going places, and they're well respected, and their stock has just been shooting up ever since it first, hit the market. But, it takes one crazy thing to happen, like they find child pornography on the computer of the CEO of the company. Or some higher up in the company decides to get caught on camera and he's saying a bunch of stupid racist crap and, using every racial slur for every ethnic group that there is and just, making everybody feel like garbage. Well, guess what happens to this company the next day? They get canceled and their stock, is at, $20 today and it's at 78 cents the next day. Okay? So for every $20 you put into investing in this stock, if you sell it now, you get 68 cents back. Wow. You lost a lot of money, and all because some idiot got drunk and tweeted something that he shouldn't have. You see what I'm saying? There are those kinds of risks. Now, when you're dealing with, these big, stable, mega companies, those risks are small, like General Electric or, even Microsoft or, something like that. These companies have been around for a long time. They've had their ups and downs, but by and large, they're stable. And they're so big that any one person can probably do some stupid stuff without bringing the whole company down. Because this company is worth so much money, the market is not going to just crucify them on account of one idiot doing one stupid thing. Whereas with these small companies, that's a much greater possibility. So what's the trade-off here? Those big stable companies, well, they're not very volatile. They grow slowly over time, nice and steady and stable. You can generate a return on your investment, but it takes a long time and it's going to be a modest return on investment. But the risks are also much lower. Lower risks, lower returns. And then if you're an investor, you've heard this expression a lot. You need to diversify your portfolio. Okay? That's great advice for investors. Don't put all your eggs in one basket. That's what they say. Well, it makes sense because Microsoft is going up. Microsoft could just as easily go down. They're on a winning streak. They could get on a losing streak. So don't put all your investment into one company. Invest some in Microsoft. Invest some in Tesla. Invest some in Amazon. Invest some in, 2 or 3 other companies, maybe even in different sectors of industry. So don't invest everything in tech. Invest a little bit in tech, invest a little bit in life sciences, invest a little bit in retail, and invest some in media. And now you've got a fully diversified portfolio. And that's good because now you're indemnified or protected against different calamities that could happen to any particular company or any particular industry. So if Microsoft fails, well, you only had 15% of your money in Microsoft, so 85% of your investment is safe. But what happens if the whole tech industry starts to collapse like it did back in the year 2000? Well, if you were diversified, but it was still mostly in tech, now you're still going to lose a lot of money. But if you're fully diversified, and you're diversified between different industries, tech can collapse. That's okay. You've got some money in banks, some money in pharmaceuticals, some money in, manufacturing. and you're just like, well, it sucks that some of my investment went downhill, but everything else has been growing and doing fine. And now the only thing that, you're really not protected against is an economic, collapse or disaster like a depression or something like that. And, that it doesn't matter how diversified you are, a global depression is going to bring the value of your investment down. So there's a way to, diversify for investors and stay safer, but there's no such thing as 100% safety. For traders like myself, there are different strategies. For people who are trading big institutional funds, i.e. they're out there playing the market with other people's money, they have to be very risk averse, meaning you buy a stock when you are nearly 100% sure that it's going up and is going to keep going up for the next little bit. And if it starts to go down anything at all, you have to jump off and run screaming. You can't suffer any decline whatsoever. And you ride it as long as it seems to be going up. And, once it even smells like, it seems like it's about to start going back down, then you jump back out. You're getting little small bits of, increase. You're getting 1% here and a couple of percent there. But you're playing very safe because you're playing with larger sums of money. And then for longer term trades, you're not trading with, if you've got $100,000 in your account, you're not trading the whole thing in one, stock or one instrument at a time. You're maybe only putting 10% here and 5% there. And if it seems like a really sweet deal, maybe you go in 20% on that one. But you're being really cautious with your money. You're not playing with all of your money, and you're being very temperamental about whether that stock goes up or down. That's for people who are trading with corporate funds, with other people's money. Okay? The last thing I'm going to talk about is some jackass like me who only trades with his own money and is trading with money that, honestly, it's not my life savings. It's not even what I consider to be a lot of money. It's a significant enough amount of money that it's worth my while to trade. I trade with $10,000. I keep $10,000 in my brokerage firm. And I am considered a high-risk trader, okay? Why? What do I do that makes me high risk? Well, I trade with my whole amount of money, all $10,000, every time I trade. And right away, there are, people that trade that say, oh, God, no, don't do that. Oh, you're going to lose all your money doing that. I don't lose all of my money doing that. On the contrary, I make about 60% return on investment every single month. So I wouldn't call that losing all my money. What I do is I find a stock and I screen that stock and I analyze that stock a little bit, and I make sure that there is very little chance that that stock is going to go down significantly once I buy into it. And once I buy into it, I buy in when there is a very, very high probability that this stock is going to go up at least about 3% within the next, let's say, 48 hours, okay? That's the kind of trade that I look for. And when I find that trade that has been in a certain range for a certain amount of time, and it's very close to the bottom of that range right now, and this is a high volatility stock that's always going up and down, and I have every reason to believe it's gone up and down 20 times without going below this point. And here it is down at this, bottom of this range. I have every reason in the world to believe this thing's going to come back up within a day or two. I take all 10,000 and I dump them into there, and I set my alert. And once it gets up to that level that I know it's going to hit, my phone beeps and I grab my phone and I start watching that stock. And, I knew it was going to come up at least this high, but there's also a possibility that it keeps going higher. So now I start watching. And once that, kind of gets up in that level where I say, okay, it's about to turn around, I sell it. I take 3, 4, 5% profit. And that was for a trade that I might have been on anywhere from 4 hours to 2 days. And, getting 3 or 4% in a day or in 2 days, that is fantastic trading. Okay? That is a lot of money. If you're just starting off and you're only playing with maybe $1,000, and I say 3%, and you whip out your calculator and you're like, $30, but $30 is nothing. 3% is a lot in a day, because there are 30 days in a month, about 20 trading days in a month. So if you make about 3% a day on average for 20 days, well, and that's not even talking about if you're compounding that gain, if you're reinvesting all of your money, if you're taking out all of your profits. $30 a day times 20 days, you've taken $1,000 and you've made $600. That's actually a pretty good return on investment, especially when you think about building that $1,000 up with your earnings, turning it into $10,000 or $100,000. Now if you're playing with $100,000 and you're getting $40,000 to $60,000 earnings a month, that's actually kind of a lot of money for most people. For me, that would be a lot of money, okay? That is an example of riskier trading, because what happens if I put all $10,000 into a stock and I decide, well, it's not going up today, but I'm going to wait till tomorrow because I think it'll go up to tomorrow. And then once the stock market closed, that's usually when most of the news comes out about companies. And all of a sudden they announce really bad news that nobody expected. As soon as I wake up in the morning, this stock that I bought at $10 instantly starts to fall and it goes down to $6. I just lost $4,000 all at once. Oh, sucks to be me, Now, that happens sometimes. You know what? The most I've ever lost on a single trade was about $1,500. I put in $1,000, I got $8,500 back. Why? Because I expected that there was going to be some good news coming out, and it was a risky trade, and I knew it, and I bet on the good news because there was a 60% chance of good news and a 40% chance of bad news. The bad news won, and by all accounts, the market overreacted to the bad news. So the stock dropped, and I waited a little bit, hoping it was going to bounce back up. It didn't. And ultimately, I saw an opportunity that I knew was about to go up, so I sold at a loss. I got out, I put my $8,500 into this other stock, and I made 2 or 3 trades over the next 48 hours, and I got all my money back with those 2 or 3 trades. So, is it possible to lose money trading sometime? Yes. Do I lose money sometimes on trades? Yes. If you decide you want to follow my strategy and trade the way I trade, will you lose money on some trades? I promise you will. Absolutely yes. But I gain money much, much more often. So much so, in fact, that when a trade goes the wrong way and I cash out, it doesn't even affect me. I don't even care. Whenever I was in high school, I got my second job, and it was being a waiter. I was waiting tables in a Pizza Hut in Midwestern USA. And most of the time I was always charming and I was fun, and I'd play around with, my customers, and we'd laugh. And I almost always got really, really, really good tips. And every once in a while, I'd get an asshole in there who gets great service and doesn't leave a tip. And, here's a piece of financial advice. If you have money to eat in a restaurant, but you don't have enough money to leave a tip, it's because you don't have enough money to eat in a restaurant. Stay home and fry an egg, okay? There. Enough said, waiters, you're welcome. But every once in a while, I'd get one of those tables that wouldn't leave a tip. I didn't get bent out of shape about it. I didn't cry, because I knew that by the time it was all said and done, I was still making a ton of money. Once in a while, I don't get a tip, but 90-something% of the time, I do get a tip, and it's usually a great tip, and it's usually better than the other people working with me. So, hey, no problem. It's just a fact of life. You win some, you lose some. You just got to make sure you win more than you lose. And if you're comfortable with that, this might be the thing for you, and it might be a good way for you to make money. That's it. I just wanted you to know a little bit about how risk works when you're trading instruments on a cash basis, which means obviously only spending money that's yours and only trading stocks that you actually own. Okay, so no short selling, options, futures, all that stuff. That's the risk. The risk is you're going to buy it and it's going to go down in value. The risk is that you're going to be holding it and some bad news is going to be released and it's going to send the price falling through the floor. The risk for investors is you're going to put all of your money into one company and that company is going to perform badly. You're going to put all of your money into a single industry and that industry is going to have a significant downturn or disruption. You're going to put all of your money into a well-diversified portfolio and then there's going to be the next Great Depression, and even as well-diversified as you are, everything's still going to go down. So are there risks? Yes. Is trading inherently risky? It's like driving a car. Every time you get in the car and you drive to work, there's a risk of drunk drivers. There's a risk of someone jumping out in front of your car and you running them over. There's all kinds of risks when you drive a car. And chances are you've probably been in an accident before and got a speeding ticket or something like that once or twice. But most of the time, the benefits outweigh the risk and the successes outweigh the losses. So by your calculus, it's still worthwhile to drive a car. Likewise in trading, there are always risks. Yes. Sometimes you will lose. Yes. But by my calculus, it's very much worthwhile to get into trading, because if you are halfway responsible about it and even a little bit good, the wins will definitely outweigh the losses and you'll walk away making a ton of money. That's all I've got for you. Thanks for watching. If you like what I'm doing, subscribe so you can see more of it and get smarter up here and make more money. Thanks for watching. Have a great day.